There was no double top, there was no daily trend reversal, there was no slowdown. The markets took the holiday opportunity to rip to brand new all-time highs, making our job pretty straightforward here. Welcome to the Trade Brigade weekend episode. My name is Matt, and I want to show you the pullback long trades that I'll be watching for, as well as the data points that'll help me build confidence, or a lack thereof, in those opportunities. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with just a little bit of a lower wick, if anything, indicating that dip buyers are still stepping up here. However, the close of the weekly bar is really the most impressive. Of course, it's a close at the top of the weekly range, but most importantly, it's engulfing the two upper wicks of the prior back-to-back inverted hammers. So as we know, there was the threat of a daily double top here. There was no breakdown through the neckline. There was no weekly pullback to retest the breakout point down here. And the strong close at brand new all-time highs does strike me as a very bullish takeaway on the higher time frame. If we're thinking about the bar-to-bar count, we do have a very nuanced higher low as well as a higher high. So the buyers remain in control 2 for 2 on the weekly time frame chart. If we're thinking about the trend, of course, it's up with lows, higher lows, soft higher lows, never actually flipping into a daily downtrend here. And along the way, we had highs, higher highs, and we just printed brand new all-time highs. Now, there is no indication that a weekly pullback is going to be imminent here. However, if something were to emerge, because we're in such a strong uptrend and we're sitting on the highest high, we can afford a higher low pullback. So what might some reference areas be? Of course, it's going to come back down to these good old fibs. If we do something from the pullback low up to the most recent high, the 38.2 is the retest of the breakout area here. That level is around 531.50 on your weekly time frame. How might that actually be accomplished? Well, let's throw on another fib from the bottom of that hammer up to the all-time high. If we were to break down underneath this 38.2, that would also trigger the daily shelf of support to break, and then we could see a move into the 61.8 on the smaller Fibonacci sequence, which is confluence with the 38.2 once again at that 531.50 level. So on the weekly time frame chart, if you're really looking for a turnaround, you've got to flush underneath all of these equal lows. And with the really strong weekly close up here, I'm not necessarily convinced that that's a higher probability outcome as we head into this upcoming week. Let's check in on the anchored view apps on the weekly time frame chart. Over time, this will start to provide confluence around that magic zone, around 531.50, right? So just keeping that in the back of our minds as well. Let's bring out the volume profile on the weekly. We'll zoom out on this. And I think that this totally reinforces the take we've had so far. So remember that the bottom of the back-to-back inverted hammers was a high volume node. And if we were to have broken down underneath the lows, there was a low volume void into the retest of the breakout point here, which was that 531.50. It simply never took place, but it does reinforce the idea that if we were to see that breakdown, that's likely what we're watching for, right? If we continue into blue sky territories, what do we have for some measured move targets in the upward direction? Let's bring out the Fibonacci's from the cup and handle, just extending directly on top of the cup. 570 is still a bit of a ways away. I'm not necessarily convinced that that's in play for this week, but what if we check in on the bull flag from this perspective here back down to the pullback low? That's definitely within striking distance, much closer to 558 here on the weekly time frame chart. Let's bring it on down to a daily chart now and firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right hand corner. It explains how we come up with these numbers every single week. If we're contained by the upper bound, the number is here at 561.24. That of course would imply a higher high and a brand new all-time high. If we're contained by the lower bound, the number's at 548.02, implying a higher low. I also really like that the expected move low is over the top of the balance range from back over here. This is where a bulk of that balance was taking place. If we spot a higher low over that level, to give you the actual number, it's 547, that would look like a pretty picture perfect setup on the daily time frame chart. So let's talk about trend. Of course, it's up. We have lows, higher lows, higher lows. these were soft higher lows. Remember, there was no hourly downtrend in this pullback, or really just sideways consolidation, or what we had over here. There was an hourly downtrend over here and again over here. So on the daily chart, this balance was actually starting to neutralize the trend. Obviously, with the breakout into the end of the week, we have a new higher high, and the trend has flipped back again in the upward direction. So as we walk forward, if there are any continuation plays in the upward direction, very straightforward stuff, we're looking for the upper edge of the weekly expected move. 560, 558 is also the weekly bull flag breakout we were just describing. If there is going to be a pullback, totally reasonable to be thinking about something that does this, to retest the upper wicks of the weekly time frame. Remember, we were talking about a double top. Those are the two highs. A retest of that area at 549.50 looks really attractive. Trying to spot a daily hammer candle at that area, hourly double bottoms there, hourly inverted head and shoulder there. Any reversal pattern really stands at 549.50. That's looking like a fantastic spot for a break of this balance range, a retest of the highs of this balance range, and continuation in the upward direction. If we fall into the balance range, not the end of the world for the reason I was describing just a moment ago, that a bulk of the consolidation actually took place underneath 547. So if there's a deeper move to the downside here, take all three of those indications, hammer candle, double bottom on the hourly, inverted head and shoulders on the hourly, rinse and repeat them at 547. If we're above either of those two key areas, I would be bullish on the daily time frame chart. It sort of leads to the next question then, where would you change your tone, Matt, and say, okay, this is looking more so like a failed breakout? Well, number one would be if there is a reversal back down into the 547, and then on any rebound attempts, there's actually a lower high that's set underneath 549.50. In the case of something that looks like this is definitely a look above and fail. You would want to be short up against the lower high or the equal low flush to target the bottom end of the balance range. If there's a straight up Armageddon crash, maybe CPI comes in hot this week, and we get a move directly to the lows, of course that's looking like a failed breakout, and you could do the same thing. You could either look for a lower high underneath 547 or an equal low breakdown, and that would start to trigger the sequence on the weekly chart we were just describing for that deeper pullback to retest the 531.50 breakout area from back over here. Again, these pullback situations seem like lower odds considering the strength and the direction of the trend, which of course is up right now. The markets are bullish. I'm not, overly aggressive these bearish situations, but they are back pocket ideas if we need to change our tone. The CPI gap close from last month would be one of the first targets to the downside underneath 543.20. That's going to be between 540.32, the gap closes, at 537. Let's take it on down to an hourly time frame chart now and really walk through how these situations might unfold. So of course the trend is clearly in the upward direction, but I do want to point out that this is thin structure. There's really not much give and take, back and forth retest of key levels ever since the bottom, which I would say was primarily produced on Monday. Notice Monday looks underneath the lows of the Friday lower wick, rebounds to set up this flat top, and Tuesday was really the sort of, highlight of the week in my view for the trade that unfolded. Break, retest, higher low over the Monday high, and continuation into the afternoon. That was a thing of beauty over 545.25, but what this continues to suggest is that stronger sellers are simply not here. Otherwise, they would have accelerated on Monday morning underneath the Friday low of 2 weeks ago. It simply did not take place, and we can see the rest is history, printing that brand new all-time high. So again, how does this all unfold? How do we get involved here? A couple of things. Let's talk about the continuation play first, because I think that's the most straightforward. If we open in Friday's range, break, Brigade bolt over the Friday high, good to go, tight risk, reward is back in the upward direction, trying to pick off a 2-to-1, 3-to-1. Maybe we look at 558 as that weekly target as well as a possible sort of situation to be aiming at to provide the risk-reward ratio in the first place, right? So that's to the upside. If we open on a gap up, obviously it's gap fill reversal, something that does this, long off of the Friday high of day. If we're in range and we start to fade off a bit more aggressively, again, looking for hourly double bottoms here over 549.50, inverted head and shoulders, even if it's a very long lower wick on an hourly bar off of this level, certainly would be willing to consider that as an opportunity. As we also described on the daily time frame chart, we could see a move a little bit lower to retest the top of this as the primary consideration of the balance, right? Something that does this is still very much so in force. Same thing with the inverted head and shoulders, same thing with the hammer candle. Just in this situation, you want to be mindful of that lower high, right? If you were to get the lower high here, it starts to become, okay, tread with caution a little bit. We know that an equal low breakdown under 547 at least gives us an open mind for a possible rotation to the bottom end of the balance. So this is a back pocket situation I would really prefer to see. And if you're skeptical of this, like, let's just dial it back here, Matt, give them an actionable takeaway. The actionable takeaway here, if you're trying to spot the higher low over 547, might just be a Brigade bolt off of that level. What does that look like? Well, it's a breakdown to here. Maybe it's a double bottom that looks like this. And instead of taking the neckline break, it's your higher low over the neckline over the 549.50. That right there, this little circle, would be a really strong long opportunity, right? You've got yourself a pullback. You've got the brewing of a daily higher low. You have an hourly higher low. The trend is back in the upward direction. You're aiming at equal highs, right? So that would be a situation to the upside. To the downside, once again, because I do want to give you these back pocket situations, say that this double bottom fails down here and you look for something that looks like this. That would be a possible short on this lower high to target the equal low. And if these equal lows break, again, you're looking for that flush. Let's bring out the red crayon. There we go, to the bottom end of the balance. So it really boils down to, in my view, if the pullback happens, how does the market react off of 547 and 549.50? The best thing that could take place, show me one of these. This would be, if I could give you my favorite setup, probably the inverted head and shoulders. It's basically a Brigade bolt built in, right? You support the level, you bring in new money shorts under the level. They get all excited. Oh my goodness, look at this failed breakout. We're back underneath the two equal highs. As soon as this higher low prints right here, you could take it over the neckline. You could take it on the higher low if you could spot the 5-minute reversal. You're targeting the equal high. That's really strong because all of the shorts you got in prematurely without actually flipping into an hourly downtrend, they're going to squeeze out and they're going to send you back up towards those highs. So that would be my preference here. Are we getting any confluence out of the anchored view apps intraday? The answer is absolutely. So Monday's anchored view app, which again is really where this reversal to the upside has stemmed from, will be confluence with the 549.50 earlier on in the week. As we move throughout the duration of the week, this CPI anchored view app will slowly, it's going to be very, very slow, right, to catch up to 547. But if you notice that the market's coming down heavy and you throw this on, you're seeing it right there, it would certainly increase the confidence I would have in trying to buy 547 as a pullback long and not necessarily be overly fearful that you're going directly to the bottom end of the balance at 543.20. So from everything I can see here, the bulls definitely have more of the edge, and we know how we're participating. The last thing we could do is just throw a Fibonacci on the sort of move from last week, and notice that we have a 38.2 here and a 61.8 here, totally reinforcing the ideas that 549.50 and 547 are your two main levels for pullback longs headed into this upcoming week. What do we see out of the market internals? Let's get a bit more granular here. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. I've got to give credit where credit is due, right? Was there really any strong exchange level buying that was taking place on Friday? The answer is simply no. There were not a ton of volume inflows. The advanced decline line was technically negative, and the cumulative build on the tick was also technically negative. Now, I'm not saying this to be doom and gloom, oh my goodness, these pullback levels are going to fail, but it wouldn't be a shocker to me if the market pulled back before trying to get continuation in the upward direction. So take note of that, but also, like, as the market was consolidating on Monday, right? Monday morning, as we were coming into those pullback lows, was there anything severe in the internals? I mean, not really. We were not at severely oversold volume outflows. The advanced decline line was somewhat concerning, approaching trend lower zone, but if you actually look at the intraday index score here, it flipped positive by the time the day closed, and the cumulative build, although negative, yes, was nowhere near substantial at negative 5,000. I mean, it was hardly scratching at negative 3,000 by the time the bell actually rung, and at that point, price action was actually back up towards the highs of that individual session. So I'm still not seeing the stronger evidence for, oh my goodness, sellers are here, duck and cover, markets are going to zero, but I would want you to be mindful of the lack of participation on the Friday session in the upward direction. Let's finish up the S&P side of the market with the market profile. If you're not familiar with this dashboard, or chart type really, check out the video tutorial in the top right-hand corner. The main takeaways here are really that value continues to drift in the upward direction. Here's Monday, here's Tuesday. A big takeaway out of Tuesday, actually, is that we had a small string of single prints in I period building a double distribution, right? Lower distribution here, upper distribution here with a spike from M period as well. If we take a look at what happened on Wednesday, value is not only completely breakaway from the previous day's value, but it doesn't even, the low of day is not even underneath the spike from M period on Tuesday. So as I continue to sort of reflect on the price action and think about who's in control of this market, stronger sellers are definitely not a component of the side of the trade, which is driving things around, right? What do we see on Friday? Does it confirm the breakout? Absolutely. Look at your value area higher, point of control higher. On the Wednesday session, I like that the point of control was lower because that means it would have been harder to turn these traders into overhead supply. A bulk of the positions are held from lower. Notice on Friday, a bulk of the positions are held from higher. So yes, it technically validates the breakout, but if there is going to be a pullback, if you're underneath the point of control, the odds of that pullback would sort of increase, right? So that is sort of a supporting data point for possibly looking for the pullback in conjunction with what we were just describing out of market internals. With that said, let's take a look over at the NASDAQ. Taking a look at the QQQ NASDAQ 100, what do we see out of the structure and location? A lot of overlap here with the S&P 500, so solid green-bodied bar, a little bit of a lower wick indicating those dip buyers still stepping up, and a very strong close engulfing both upper wicks from the back-to-back inverted hammers. On the bar-to-bar count, we do have ourselves a higher low as well as a higher high. Buyers go 2 for 2 on the weekly count. If we're thinking about the overall trend, it's definitely up with soft higher lows here, highs, higher highs, and brand new all-time highs. Just like the S&P, no indication of a pullback looking imminent, but if something were to emerge, a weekly higher low is definitely in the cards at a couple of key locations. Can you believe it? It's the same concept as the S&P with our Fibonacci's. The key level here, the breakout retest, would actually be a little bit underneath the 465 area. You'll notice I would count it as the top of the red bar over here. That's much closer to 460 on the nose, and if we come in with the fib from the smaller range like such, this 38.2 is still technically the lows of the prior 3 weeks worth of trading activity, and the 61.8 is confluence with the 38.2. Again, that level is closer to 465. The key technical structure I would pay attention to is much closer to 460, and this level up here, FYI, is around that 476. What do we see if we bring out the anchored view apps on the QQQ weekly? These are a little bit further away, but again, over time, just building confluence around that zone, 460, 465, if you will. Let's bring out the volume profile out of the QQQ, see if we get similar sort of indications out of this, and the answer, of course, is absolutely. Here is your high volume node directly through the lows of the 3 equal lows, the 38.2 as well, that 476 level. If you break down underneath, not unreasonable for a retest of that 460. 460 is almost the high volume shelf. It's actually a little bit lower than that, 459.50, so you're kind of splitting hairs here on the weekly, but you get the idea. That's where the next major shelf is. That's really what I would look for a weekly higher low. If we're thinking about extensions into blue sky territories and possible targets, just remember that we have hit the cup and handle from the pullback low, but the measured move target here is still pretty far away. I'm not necessarily convinced that we're thinking about 519 into the coming weeks worth of trade. I mean, if we get a rinse and repeat of the range from last week, we might get close, but that's kind of a stretch here. What about the sort of measured move from this weekly bull flag, confluence directly at the 519. So those are the ones that are primarily in play, and this, of course, has already been achieved. If you're trying to capture this weekly bull flag, smashed the target on that one as we headed into the Friday session of last week. Let's bring it on down to a daily time frame chart for our NASDAQ 100 and see what's going on here from a weekly expected move perspective. What do we see? So completely disjointed expected move this week, which is pretty incredible. The upper bound is going to be at 504.50. That, of course, is a brand new higher high, a new all-time high that's bullish. And the lower bound is right here at 487.83 over the top of the prior balance from this area in this zone. So bullish expected move. Trend, of course, is up. A lot of rinse and repeat here from the S&P 500. Any higher lows over 486.75 is the key level that I would use. Look fantastic. Same indications, daily hammer candle, hourly double bottom, inverted head and shoulders, Brigade bolt. The Brigade bolt on the daily could look something that looks like this. Correct, so that would be supportive over 482.25, these sets of highs in here, and then a higher low over 486.75, long on this into the equal high rotation, and this, to give you a rough sense of a target, would be closer to 496 on the upswing. There's not much more to dive into other than that. Just like the S&P, if you were to get some sort of low in here and then a lower high underneath 486.75, I would change my tone, and of course the breakdown where this is truly a failed breakout, you're bringing in a daily lower lower low would be underneath 475.35 on your QQQ NASDAQ 100. Same targets. You would be looking for a CPI gap close, then a weekly retest of this breakout point here, which, as we described, is closer to 460.50. 465 is the top end of this balance range from back here, but I would put a lot more emphasis on the open of this bearish engulfer, which is the top of that red bar on the weekly we were just exploring. Let's bring it on down to an hourly time frame chart. Just like the S&P, thin structure on the way up. It can be retraced, I don't want to say easily or quickly, but there's not many positions there to defend in terms of stronger consolidation going sideways. Oh, look, we have this level. None of it, right? So on any sort of retracements opening in Friday's range, maybe a lower high into the sort of Wednesday range over here, you could look for this, and then I would be bullish here, looking for double bottoms, inverted head and shoulders, right? Hammer candle, all the same indications that we've been describing so far. 486.75, 482.25. This would be the concern, right? Let's say you get a double bottom down here, you reverse, you get sort of the same thing that we just drew in on the S&P 500, right? This head and shoulders would be fairly concerning. On this one, out of the NASDAQ, I would probably be more patient for bringing in the short. I would not want to short it here, and more so would be through the equal low, looking for the bottom end of the daily balance over here. So that's a small difference between the QQQ and the NASDAQ 100 for your short. Wouldn't really want to get involved on this possible lower high under 486.75. Only really thinking about the equal low breakdown if it takes place at 482.25, or if it's really detrimental. I mean, show me a lower high here. That one's pretty obvious as well. That could be a possible short indication there. But remember, we're talking about downside levels because they're really the only reference points we have, but the market is totally being dominated by the bulls right now. I don't want you to lose sight of that just because we're talking about pullback reference points. Opening in Friday's range, break over Friday's high, higher low above, there's your Brigade bolt, and now you're sort of rocking and rolling with a tight risk setup into the expected move high or some sort of blue sky target, correct? So don't be the suckers long, but if the opportunity presents itself on tight risk, certainly thinking about trying to exploit the market's moving in the upward direction for continuation. We'll check in on the Fibonacci's from the Monday low up to the Friday high. 50% retracement is the top of the balance range. 61.8 is actually over this key line in the sand. I would say for me, 482.25 is the key line in the sand. As I'm sort of verbally talking through this analysis, the more I'm focused on this level, the more, in my view, as long as we're over 482.25, I would tend to maintain the bullish stance here. So number one, pullback stop, pit stop number one, pit stop number two, looking for longs, looking for longs, looking for longs, and even something that does this is an opportunity as well. We've been pretty clear about how we're looking to navigate these particular levels. Intraday, beautiful confluence here. This one's slowly creeping up, also providing confluence 482.25. Market internals for the NASDAQ side of things, a little bit stronger on that Friday session. Notice volume inflows. I'm not going to sit here and argue that they were like, oh my goodness, substantial, 400 million. No. Absolutely not, but at least positive. Advanced decline line was not positive, actually underneath the zero line here, so balancing things back out. And the sort of cumulative build as well, a little bit more mild than anything else. It's technically negative. So still open-minded to this pullback unfolding, but it's not some severe like, oh my goodness, let's short this thing with both hands and try to capture a home run trade. No, it's more so patience through the pullback and then trying to hammer it home long back in the upward direction. Interesting divergence from the market profile perspective is the poor high out of the NASDAQ on Friday. So the auction did not end properly up there. If you're not familiar with the poor high, you can check out the blog article on our site all about poor highs, but this would indicate the improper end of the auction. Looking for that to be repaired is basically asking for another attempt for an all-time high breakout. And again, the Brigade bolt over that high, so repair it by trading through it. Higher low above, that's a long opportunity looking for blue sky territories in the upward direction. I love the lower wick, the lower tail, if you will, in A period. The volume taper down here, that's looking solid as a secure low. If you read back into sort of the Tuesday highs, right, we did this in the S&Ps, you just didn't fall through the thin volume node into the value area from Tuesday. All of value on Wednesday was contained in the upward direction. That does strike me as, once again, overall participant-wise, more bullish than bearish. All right, you know what time it is. IWM Russell 2000 and the small caps on a weekly time frame chart. One of these things continues to be unlike any of the others. We've got ourselves a red-bodied bar with just a little bit of a lower wick, just a tiny hair of an upper wick, nothing to read into there. It's an inside bar as well. So structure is definitely more bearish. Location is fairly neutral here. So on the weekly time frame small cap chart, don't really think you have much of an edge going on. If you're trying to count the overall trend, you do have lows, higher lows, maybe higher lows here, along the way highs, higher highs, higher highs, lower highs. Is it possible that we have another set of lower highs? Absolutely. In my view, the small cap range is just in a phase of compression, and hopefully, if you're trying to remain bullish the market, we would look for a break of the resistance trend line for some sort of equal high attempt at 210, and then continuation in the upward direction. Based on last week's performance, I'm not sold on the idea that we want to do anything aggressive here out of small caps, and as a matter of fact, I think there was actually a failed attempt to hold over a pretty key area. If we bring out some Fibonacci's, I do want to just reinforce that all of this is still technically happening over the 38.2. If we count from sort of point A down here to point B up here, if we bring in a smaller 38.2 on this range here, we did fall back down into no man's land, which is in between the 38.2 and 61.8. If we bring out the anchored VWAPs on the IWM chart, we do have to bring out many more years so we can encapsulate the sickness high and low as well. All of this band is below us, trying to act as what I would argue is more appropriately monthly support in the upward direction there. And what about our volume profile on the weekly here? This is going to be absurd because of how much time there is to look back through. But if we do something that looks like this, you just get the sense that we're sort of underneath at this point based on last week's reversal back to the downside. I wouldn't say underneath this high volume node. That's certainly a little bit lower. You can see that that's actually acting as support over here, but you're not getting that thin structure, thin low volume void rotation in the upward direction back up towards the midpoint or even upper third of this previous consolidation up here. So the fact that there's no acceleration, the fact that the market's more neutral out of small caps continues to be neutral in my view for the S&P 500. Last week, I thought we were going to have a little bit more of a bullish divergence, something helping in terms of tailwinds, but as we'll see on the daily time frame chart here, there actually was no key hold of the level. So first of all, we'll walk through the expected move as we typically do. What do we see? Upper bound is at 204.59, lower bound is at 197.13. This is equal highs. This is a lower low, I would argue, to some of these lows over here. Maybe an equal low. It's honestly a nuanced lower low at 197.13. But the key thing to take away of the daily chart is really the opportunity that 2 weeks ago now on the Friday session, we had the hammer candle gap fill reversal over the top of the 202 area. We opened over that on Monday. We tried to get above on the half day Wednesday, right? And then no love. I mean, on Friday, we're certainly underneath, back down inside of this as a balance range. So the buyers are not really seeing the follow through that's required if we're looking for a stronger tailwind, an argument to be more bullish over in the S&P 500. I mean, the best bullish thing that could have happened would have been this break being a higher low above and a rotation to the top of this daily range from back here. It simply never took place. Now, if we think about the structure from the Friday bar, it's definitely a hammer candle, and it's got a longer lower wick off of our key weekly line in the sand at 200. But if we're just trading inside of this range right here, I'm not convinced that you want to be, overly biased one way or another for the small caps. I mean, remember on the weekly chart, it's not like we're in a big weekly downtrend. The range is compressing here, so I wouldn't be overly bearish either. But it's hard to be a bull when you're getting failed breakout attempts. I wouldn't even call it a breakout, just a reversal attempt, failed reversal attempt. And if anything on the daily chart, you just now have highs, lower highs, equal highs, lower highs. Right back down to the equal lows would not be unreasonable. We're almost there on Friday's little breakdown, right? So small caps still acting as a neutral to maybe small headwind, preventing continuation in the upward direction, at least in terms of smooth sailing. Doesn't seem as though the S&P has really cared as long as the NASDAQ itself is aggressively pushing into new highs as well. So boil it down to its simplest form. If you're under 202, neutral. If you're over 199, neutral. If you're over 202, bullish on small caps. If you're under 199, bearish on small caps. And of course, it's carryover to the S&P 500. Not much more to elaborate on over here on the hourly time frame chart. The price action is absolutely pitiful. Again, stronger buyers should have tried for a higher low here. This lower high underneath. Finally, we're above. We closed right on it. Friday's a pretty detrimental open back down in the lower range. Tried to find support here. It's just all over the place. Barcoding activity. I would keep it simple. 202 and 199. Use that as your bellwether gauge for the S&P 500. We can come in here with the the anchored VWAPs rather intraday, see if there's anything interesting going on. Not really. I mean, we're underneath technically the cluster. This, of course, is acting as potential resistance. So if you notice we're under 202 and you have a little bit more of a bearish tone for the market, I would say under 202 with attempts into 199, the door might be open for that breakdown, causing some headwinds in the S&P 500. Russell internals, not much more to elaborate on here other than what we've already described. So this actually makes a little bit more sense with the sell-off on Friday. Outflows from volume perspective, advanced decline line, negative over here, and the cumulative build actually speaks volumes, right? Really suggesting that at the but index-wide level, counting everything in the Russell 2000, not a whole lot of love for many of the participants. Big build there to the downside relative to what we saw in the S&P and the NASDAQ. And then we'll finish it up with the market profile, of course. What do we see here? It's a totally different picture. I mean, here is your Monday session. Here's Tuesday. We're good. Here's your Wednesday half day, right? So value is just mildly creeping in the upward direction on Wednesday, my apologies. There was no strong attempt to hold up over the high of the Tuesday session like we saw in the double distribution in the S&P or even just the value area in the NASDAQ. And you can see on Friday, value is actually completely breakaway to the downside from Wednesday and starting to even take out the low of the value area from the Monday session as well. So small caps, they don't look great here. I would, again, try to maintain a little bit more of that optimistic and neutral stance, but if there's going to be a tech sell-off, you've really got to see small caps play catch-up and see a move over 202. So to give you the if-then statement, we'll end on this for the Russell. If the NASDAQ is breaking down aggressively, if it's not holding those key pullback long areas we were just talking about, and the IWM is also weak in here, under 202 testing 199, I would not be looking for grand slam long opportunities on the pullback for the S&P 500. If the QQQ pulls back aggressively and the IWM small caps are over 202 with a higher low trending towards the top of the range, 206, 207.75, guess what? S&P 500 might not be a grand slam long, but it's still probably a long, even if your NASDAQ is breaking down. If both of these things are in the upward direction, so the NASDAQ is still strong in the upside, and the small caps see a reversal over 202, that's your grand slam situation for the S&P 500 looking for the follow through into those blue sky territories. Let's continue to get granular here by evaluating the weekly performance of the S&P sectors. Leading the pack is the XLY consumer discretionary up 3.38%, followed by the semiconductors ETF and then the technology ETF. All three of those are heavier weight risk on style sectors. Of course, the semis are an ETF on their own. And at the bottom of the barrel, it's the energy sector, really lightweight, and it's also not really defensive or aggressively risk on. Then we see the healthcare sector, which is definitely heavier weight, but as we know, it's the defensive heavier weight sector, down 1.12%. And then down a flat 1% is the industrial sector, not really heavyweight or overly risk on or off for the marketplace. So the rotation here and the posture of the sectors does strike me as being confirming of the breakout, not necessarily divergent of the breakout. If we check in on the structural charts, what do we see? Is there anything to be overly concerned with? XLY. I mean, obviously with Tesla and Amazon both making big moves in the upward direction, even if there's a pullback, plenty of opportunity for a daily higher low. This is bullish for the market. Semiconductors look great with the Friday close over the upper wick from this inverted hammer. I actually vocalized some concerns up against the 267.50, and the fact that there was no equal low breakdown, Friday's close was back over that level, does strike me as a bullish takeaway here out of the SMH. This is nothing more than a daily higher low pullback, something like an hourly double bottom, and we're over the neckline at this point. So the more time we spend over 267.50, the more likely I would be looking for continuation in the upward direction, which of course would be bullish for the S&P as a whole. I would only become more concerned about semiconductors if there was a breakdown for a new swing low underneath 255.70. Next up, XLK, the heaviest weight risk on sector for the S&P, new all-time high. So I like the fact that this is confirming with a new all-time high hand in hand with the S&P index itself. Plenty of opportunity for a daily higher low over this point at 227.50. Consolidation up here is obviously bullish. Nothing bearish going on here unless there's some sort of move to take out what could be considered a double top neckline. We're just not even close yet. A little bit of indecisive activity on Friday, but again, higher picture. Is it possible that the market pulls back? Yes. Are any of the major sector level ETFs going to flip into downtrends on pullbacks? The answer that I'm seeing so far is absolutely not. Now, the TLT did technically outperform the S&P on the week as we were breaking to a new all-time high, but it's a really oversold reaction back in the upward direction. The fact that this did not break out to a new swing high as the market was also making a new all-time high and outperforming in the TLT doesn't really strike me as the end of the world. We'll see that in the ratio chart in just a moment. Here's the XLC, brand new all-time highs. Anything bearish to say about this? Absolutely not. Next up, the XLF. What do we see out of financials? I don't want to say I'm concerned about financials, but with JP Morgan putting in a stronger daily trend reversal, making a new all-time high, the fact that the XLF is not at least threatening 42, threatening a move into these equal highs, again, not concerned, oh my goodness, markets are going to zero, but I would have expected a little bit more out of the ETF here, the sector as a whole. You're getting a lot of drag from MasterCard and Visa, but anyways, I do like this as an indication, inverted head and shoulders over the neckline. I would probably expect some sort of attempt at the 42.50, 42 flat at least, as a possible target. So it's not bearish, but I would have liked to see a little bit more out of the XLF. That way, if there's a pullback in the XLK, there's something to sort of rotate into. And I suppose that sort of makes the argument for this remaining neutral, which is, okay, if this week we see the tech rotation, sell tech to buy what? If they buy financials, great. And what do we know is right around the corner? Financials earnings, right? Big bank earnings are coming up, kicking off on Friday, actually. I think we have JP Morgan and Wells Fargo. Citibank usually reports with those guys as well. Here's the XLP consumer staples, midpoint of the range. Don't enter in the center, don't exchange in the range. Neutral, really nothing, not much to say about that. Energy, a little bit of a pullback here back into forming a possible right shoulder, looking for that to hold over 89.55, considering what's happening with crude here. If we take a look, it continues to grind in the upward direction. I really want you to make note of this chart because this is going to tie directly into our conversation about CPI and inflation, which is going to be announced. CPI is going to be announced on Thursday at 8:30. Of course, we'll have coffee and donuts up in the penthouse, but just remember that energy prices over the last little bit here have certainly been higher, and what was the main deflator that got CPI prints cooler than expected last month? It was none other than energy, of course, right? So keep that in the back of your mind. Let's continue along, though, to the XLV healthcare sector. This is the third heaviest weight sector in the S&P, breaking down through what could be considered sort of double top from this perspective. It's still stuck in a giant trading range, though. I would consider this the range. You set your highs, sort of set your low down here. It's the midpoint of that range. I would just sort of use this inflection point here, the neckline of the double top early on in the week. If we're over it, great. Neutral. Bulls and bears both like that, remembering that this is D for defensive. If the bears are like, nope, it's time for a defensive pullback, then great. XLV outperforming is just fine. If it's down here, then the bulls are saying it's fine, it's defensive. The bears are saying, here comes bearish pressure. It's the third heaviest weight sector. So it doesn't matter how you slice this one currently. I'm not seeing a big argument either way out of healthcare. Next up is industrials, lighter weight sector in the S&P. I suppose it's threatening the bottom end of this range. Maybe it's building out a descending triangle. But until you show me the break and lower high underneath, I've just got to be sort of neutral inside of this area. Notice the hammer candle on Friday session trying to support over 120.40. So key level to watch there. If it's just range bound, then what we would expect is a move back towards the center, mean reversion, right? So 120.40, big watch. If it breaks down, but all the other sectors are still holding up, this is not going to be enough to sink the ship over in the S&P 500. Same thing over here in the XLB. Materials, yes, have broken down more aggressively finally through that neckline here. Possibility for a lower high. I mean, yeah, it's bearish pressure, but it's such a sliver of a percentage of a representation in the S&P. It's not going to sink the ship. So yes, notable, new swing low, absolutely bearish pressure, but not enough to say that the S&P shouldn't be at new all-time highs. Next up, utilities, same concept over here. This is lightweight. It's also D for defensive. So to see it pulling back as the market's making a new high, I'm not concerned about that. Real estate, really more so sideways as rates can't sort of figure out what they're trying to do. We'll take a look at interest rates in just a moment. Let's go on over to our ratio grid first. So if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. This is the glue that continues to hold the market together. We know that. We know the technology sector is really what's pushing S&Ps to new highs. Financials, I was saying that I wanted to see more, and that's directly reflected here in the weakness out of the ratio. So would love to see this outperform if we get some really stellar numbers out of the Friday session from earnings, but that's yet to be seen. I do like the start of the outperformance from the XLY. This has had a long history of being in this downtrend for, going on a year now. I'd like to see this break trend and start aggressively moving higher. That would be a supporting piece to the XLK where, hey, maybe things are broadening out in the S&P. So monitoring this closely, but would really like to see more outperformance out of financials. This is not an issue. 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 Communication's trying to perk up here, but nothing crazy. Obviously with Google breaking out, that's been a bit of a help there. Let's move into some specialized ratios. All of these are going to be the same. They are going to be risk on, but what I do want to point out is that this made a new all-time high with the market. That is bullish. It's a little bit more nuanced than our usual take, which is just, okay, it's an uptrend, it's bullish. No, made a new all-time high with the market. Same thing here, not a new all-time high out of the ratio, but it did make a new pivot high, new swing high out of this particular instance as the market was making that all-time high. I like that. Let's take a look at apples to apples. I like the break of the balance range, finally over that 2.38. We know that this thing has been just stuck for a long, long time. This is helping, right? As Tesla and Amazon really start to get in gear, I think that you're going to see, again, some broadening outside of just your tech, your Microsoft, your Apple, your NVIDIA. It's going to be more so the Amazon and Tesla side of things as well. The Magnificent Seven might actually be a full 7 again. What do we have out of semis versus healthcare? Much more of an equal high versus the higher high. Maybe you could make the argument a very nuanced lower high, but not totally the end of the world out of this particular ratio. I think the other ones we've seen so far are much more confirming. Let's take a look at the Dixie. Dollar is breaking down into the end of the week, fueling the fire in the upward direction. That makes total sense, seeing markets at all-time highs. This is not divergent. That is not a bearish sort of indication. If we look at gold, also adding up, rotating off the bottom of the range back to the top of the range, this is bullish for equity markets down below because of the relationship with the dollar. If we take a look over at interest rates, falling down aggressively after setting another weekly lower high. It would have been better, in my view, if this stuck as the weekly lower high and all this consolidation just stayed below. But the more time we can spend under 43.33, the more time, or I shouldn't say the more time, but rather the more this looks like a failed recapture of the level from interest rate bulls, if you will, right? That would be bullish for equities down below. Easing the burden of operating environments, of course, would sustain more of a tailwind in the S&P. So I'm liking what I'm seeing here with the aggressive rotation. It's just got to make, what's the fine line we've got to balance? And we talk about this all the time. It's that the Fed can't be cutting rates because there's an, oh my goodness, whoopsie, we went too far situation and we're starting to cause some sort of recession. Just as a general reminder, let's bring up the Fed funds rate and the S&P 500 underneath. And you can see that typically associated with rate cut, all these red lines mark rate cuts, right? That's when the market goes, whoa, recession, struggle, sideways, right? Sideways, down. So we want to avoid that situation, and I think that Jerome Powell is doing a decent job so far, but as we start to maybe take a look more at the fundamental side of the data, of course, what do we see out of the tracker tool? Continued higher for longer. More of a pause. If the inflation data that comes out on Thursday is not supportive of inflation breaking back more firmly underneath or towards 2%, I think that you're going to see these odds immediately jump higher, which puts the Fed between a rock and a hard place because last week, as you sort of may or may not have seen, is the unemployment rate actually ticked higher. Now, of course, there were some 4th of July shenanigans. We did not end up being live for the Friday session morning, but I was very vocal about not being surprised to see a miss there. And again, I'm not claiming to be special for seeing that. If you look at the initial jobless claims week over week, of course they were elevated. How could you not see a bit of an uptick in the unemployment rate? So that added up. That made sense to me. We're continuing to see a divergence, between the ADP non-farm and the non-farm from the government survey, right? So this is continuing to sort of go opposite directions. You missed the expectation here. You beat the expectation here. Who's telling the truth? It's one of those things. It's time will tell. You're not really seeing a wage price spiral, so no issues out of that. And before we look forward, I do also want to show you that ISM services PMIs came in dramatically underneath the expectations, and a read underneath 50 represents contraction. This is incredibly important because what do we know about the sticky side of inflation? Of course, it's services. So the first major impression that we've seen underneath 50, if this sustains itself, this could be what it takes to finish off inflation, get it down to 2%, and sustain it at 2%. This could easily combat a bit of that more, bearish take we had, which was energy inflation is going to rear back in the upward direction because of the price of crude. Well, if services are going to take out some of the punch to that reading, this is a good first piece of evidence here on ISM services. So you don't want to see it contract too much, right? You don't want to fall into recessionary territory, and you could say something similar about the manufacturing PMI up here. Like, let's make sure that this thing curls and gets back to positive. But in terms of gauging inflation, which we know the market's obsessed with right now, and where's the first cut? It's itching for it. That would be a sort of top watch in the detailed report coming out on Thursday. So let's look forward now. Let's take a look at this upcoming week. Early on, it's going to be the semi-annual testimony from Powell, so don't expect anything other than the pre-canned responses. We know inflation's a burden. We know that people need to be employed. We know that this is not easy for anybody. It's a lot of the same. Obviously, he'll be before Congress and the Senate, so Expect a lot of political back and forth clown show trying to cement my spot here ahead of the election. I want to make it seem like I'm on the right side of things, right? So expect a lot of that. I don't really think the market is going to care too much unless he drops a total, knowledge nugget where he says, hey, we're going to cut rates in September, right? What else is going on this week? Of course, it's CPI, and this has been the big sort of hint, the thing that we've been hinting at all along today. CPI comes out. We're expecting a 0.2 here, the month over month. For the core, non-core, 0.1. Year over year, still hasn't broken underneath that 3% yet. So watching it closely, and we've sort of given you the arguments on both sides so far with energy versus services PMIs. PPI, as always, to follow it up on Friday, and preliminary consumer sentiment and inflation expectations. So that's your calendar. You're also going to get bond auctions in here. The 10-year and the 30-year are probably worth paying attention to. Just a little bit of volatility at the 1 o'clock time frame Wednesday and Thursday. Let's move it along to the earnings calendar. As we were alluding to earlier on in the show when we were talking about the XLF, this is what matters. I don't really think that any of this is going to matter. I see that these guys are advertising on YouTube aggressively, but they're not going to move the market, right? They're not going to move the market, and they might stop an intruder. You never know. Definitely not as much as an actual, device, we can say. But JP Morgan, Wells Fargo, Citi, those are your top watches into the end of this week. And whenever the banks start to report, earnings season is underway. Q2 is going to be an interesting one. So watching out for all of that stuff. Let's jump back on over to the platform. Let's finish it up with our risk appetite. TLT ratio to the S&P just because we checked in on the structural chart. Remember, oversold reaction, no outperformance. We were actually concerned about it when this was threatening a breakout, as this was also threatening a breakout. But because this is actually on a breakdown now, not the end of the world. So it doesn't seem like a huge flight to safety currently. We can actually reinforce this with multiple other data points here. These downtrends speak to duration risk being favorable for equities down below. And one of the things that we were closely monitoring was this sort of advance out of credit spreads. Those quickly contracted into the end of last week, which in my view is actually bullish for equities down below. So the fact that these contracted as the market was breaking out adds up. This is not divergent. That actually checks out as being bullish for markets. As we move into the HYG in isolation, huge divergence, negative divergence as this was unfolding, but into the end of the week back up to the equal highs. In the grand scheme, yes, flat top versus sort of a trend line here, it is divergent, but not to the degree where I would go out and start shorting the market with both hands, expecting it to roll over. So 76.60 has still been our big watch. If we take that out to the downside, much more of a reason for concern, but I'd like to see the HYG start to get in gear a little bit more aggressively in the upward direction. Bitcoin breaking down over the last couple of days. Everybody's sort of up in arms about this one. You've got to have a longer term approach. So traders, as a trader, and like my take here is that this is a slightly risk off sentiment for markets down below, but what have we seen, if anything? Money's come out of Bitcoin and maybe into equities markets on the breakout through the balance range. Not really the end of the world. This has never been a one-to-one relationship, but just kind of interesting how those two things are juxtaposed as of right now. New highs versus lows. I like that it's still positive on the week. That's starting to show some signs of recovery as we're making these new all-time highs. And if we check in on the SPX A200R because we skipped out on it a couple times, it's not aggressively underneath 50%, no issues there. If we take a look at the SPX A50R, would like to see this improve over 50%, but between the two, right, SPX A200R and 50R, this is like, okay, we've seen some mild consolidation, we've seen some pullbacks, but we have not seen aggressive daily downtrends where everything is trading suddenly, or I should just say more than half the index is trading below the 200 SMA. It's just still not the case. RSP equal weight. Not great, but also not the end of the world. It did not break down through these equal lows for the rotation into 159. The longer that this can just stay in balance, I think, again, it gives the market more of an opportunity to catch up to the all-time highs instead of the market saying, no, I'm going to catch up to the bad breath and move in the downward direction. Still very, very attentive to these lows. And, don't get me wrong, it's going to decrease some of our confidence if we were to break down here, even as the market's setting up a bullish breakout. But it's got to break down. It's actually got to take out the level if you're going to start seeing bearish pressure in the S&Ps. Notice that the QQQE actually printed a brand new all-time high as the market was also advancing here. So what does that tell me? Again, some of the bad breath is sort of isolated to some of the not necessarily heavyweight components in the S&P 500, which makes total sense, right? That should not be a shocker. It's been that way for a while now. VIX, floored, it's going to zero. Nothing to report on over here. VVIX, nothing to report on. Obviously, as the market's grinding to new highs, this is sitting on the lows. If you take a look at vol futures, strong contango floored down at the 745. Nothing bearish out of the VIX. It does open us up to the complacency effect just a little bit, but nothing to the magnitude where I would say, oh my goodness, buckle up, things are about to get bumpy. Let's move directly into the core list of companies, and we're going to stay to daily time frame charts because obviously there was no Wednesday update. We had the whole 4th of July celebration, but let's look at daily charts, really give ourselves this higher time frame perspective, right? We don't often do pure daily charts. So uptrend, higher high, new all-time high out of Microsoft. What are you looking for pullbacks? I would say that this on the daily chart makes the most sense, these equal highs at 456. If you can spot the higher low there, equal highs and blue sky continuation. Anything underneath that, my daily line in the sand, 450.75, the top end of this, rejection. I mean, you can see all those rejections. Any higher low off of that is still very much so in play to keep the daily trend up. So no major concerns. Is a pullback possible? Yes. Is there any indication of that? No. Let's move along to Apple. Same concept. I mean, just rinse and repeat. Broken record again, like we were on the Wednesday morning episode of the pre-market prep. There you have it, 219, higher low pullback area. Would I give it wiggle room down to here? Absolutely I would. So 215, major line in the sand. It'd be a little bit deeper of a retracement from point A to point B up here than you'd like to see, but not the end of the world. I would change my tone to being bearish if there was a lower high here. Can you start to envision how maybe that sets up a head and shoulders? We're not there yet. I don't want you to jump the gun on bearish ideas. This is top of mind, and this is top of mind. Looking for continue. Obviously, like opening in Friday's range, higher low over Friday's high of day, Brigade Bolt, all of that stuff is in play. What do we see out of NVIDIA? I like the sort of balance that's unfolding here, and I like this as a 3-bar range. The only thing I'm not fond of on Friday is that we technically looked over the Wednesday high and then closed back inside of that range. Now, not deep enough to a magnitude where I would say, okay, the chart's, game over, it's over. But I do think at this point, you probably need the clearance of 129.25 if you're going to see a stronger reaction in the upward direction, just because these lows are keeping this acting as overhead supply. If you continue to reject that, I start thinking more so about, okay, spot number 1, spot number 2, building stair steps in the downward direction. All of a sudden, these equal low flushes start to bring into play this as a head and shoulders. Semiconductors are pulling back. Who needs to take the sort of momentum? The baton needs to be passed to financials. So watching that closely out of NVIDIA, I do like the lower wick. I like the aggressive move on that sort of Wednesday session in the upward direction. But Friday, little skeptical of that upper wick. So just keeping that in mind here. Next up, we've got Google. You want the broken record? I'll give it to you one more time. Here you go. Pullback, higher low. I would say that this is a weekly higher low opportunity. Obviously on the daily chart, something that would look like this. This is a short all day / week long to get into that retest. So it's one of two things. It's just consolidation over, and we look for blue sky breakouts. Pullbacks into the 185.80 zone are buyable there. And I would think that consolidation in here opens the opportunity for head and shoulders, but weekly pullback long is probably the better option at 178.25. Next up is Amazon. How many times do you want it? We've got consolidation here being bullish, break, higher low, Brigade Bolt over $200.25. I would not be bearish on Amazon unless there was some sort of obvious display of price acceptance back underneath 191. On the daily time frame chart, this is a massive ascending triangle. Unless you're underneath that breakout point, I would want to be more bullish than bearish. Even just thinking about weekly consolidation building up here, show me a range, and over time, looking for follow through in the upward direction, right? As of right now, bullish 3-bar play, inside bar on Friday, threatening or suggesting at least that this is probably top of mind. That's Amazon. Next up, Metaverse. What a day. Brand new all-time highs coming from this sort of congested range. Boom, straight to highs, no struggle at this area. So what's the name of the game? You want the rinse and repeat? Here it is. Higher lows, 529.50. Higher lows over this area here, 520.50. Higher lows even at the origin of the breakout, 514 flat. If you could get higher lows over any of those areas, I would look for long opportunities to try to continue the momentum in the upward direction. Obviously, this is your most bullish setup, looking for this. This is your next most bullish setup, so on and so forth, right? The only time I would be bearish on Meta is if you're looking for a scalp. Maybe there's an opportunity that looks like this. Maybe you could get the full retest here, so it would be a trade from point A to point B. I would not overstay my welcome on the short side unless there was some sort of acceptance here. And again, daily head and shoulders, everything can always look like a possible pattern as we draw in these potential lower highs, but just like this is such a back pocket situation until it actually presents itself. So just remember that. Tesla, I mean, nonstop freight train. One thing I would caution you about Tesla is being long with poor trade location. One of the sort of things that comes to mind here is that, yeah, I mean, you're getting just this massive break of a resistance trend line. If we go out to a longer time frame chart doing something like this, huge breakout over this resistance trend line. Obviously, this as a weekly inverted head and shoulders is also quite an attractive look. But if you're buying this when it's already up, let's just take out a measuring stick here and see how far it's been up. So off the breakout day, it's up 35% already. You're buying it up 35%, expecting another 35%, a rinse and repeat of that move. Again, managing expectations a little bit. Like a lot of the move has happened breaking out of this range here. So with that kind of understanding, a couple of areas that I would really want to see hold up, this gap fill reversal is very interesting to me. If we can consolidate inside of this prior range, if there's any pullback or opportunity that looks like this for a daily flag, awesome. Trying to capture that momentum continuation in the upward direction. Anything deeper than that, I would prefer to see it stay over the daily 200 SMA really. And the top of this from back here. So that's at 206.25. If there's straight up continuation, I don't know that I would try to short this on like a quote overextended move. It's not typically my MO. Instead of trying to short something, I would much rather just try to ride the coattails of the momentum. So really consolidation effort in here. If there's a no-brainer risk reward setup and, maybe there's another news catalyst, someone gives it an upgrade coming into the week here. If we get something like that, then, there's nothing saying that it can't go again, but please just be mindful of your trade location out of Tesla. You're basically, again, the sucker's long is chasing it after it's already made a substantial move. So that's my word of caution there. JP Morgan, we were talking about new all-time highs into the end of the week, a little bit of a pullback, right? But so far, so good. This is basically at actionable levels right now. We're talking about pullbacks in a lot of the technology companies. This has done it out of JP Morgan. So can we spot an hourly reversal off of this 204.25? Can we spot a Brigade bolt intraday on a higher low over 206.50, trade into the equal highs? The pullback is underway. The line in the sand I would use has to be here as sort of an inverted head and shoulders neckline. That's at $200.75. So if it continues, let it be, and then I'd sort of, again, rinse and repeat. Where's your hourly double bottom, inverted head and shoulders, hammer candle, and try to spot the daily higher low, trying to capitalize on the momentum in the upward direction. Mild pullback so far. So those are the levels, and that's how I would really act here. I would only change my tone to being more bearish, probably on a lower high under the $200.75 mark, or as we come into the end of the week, if earnings give this thing a huge gap down, we're at 190 opening on equal lows or something like that, obviously changing tone, we just don't know until we actually know. That's obviously always the case with earnings. Next up, Netflix, all-time highs right there. I mean, look at the consolidation and look at how this has acted in the past, right? If we're just trying to sort of do a little roll call on Netflix, consolidation, yes, breakout. Consolidation, yes, breakout. Consolidation, yes, breakout. All right. So, I mean, not that it always has to, the market never has to just continue to do the same thing over and over and over again, but the opportunity is definitely there if the market's out of Netflix, at least trying to find acceptance over 687. What would probably reinforce the confidence here to really take that trade and size it appropriately? If the S&P and the NASDAQ are also bullish. If you're getting a bullish broad market and Netflix is trying to hold up over these highs at 687, I'd be looking for a blue sky breakout and sort of momentum to give us, maybe some sort of repeat of these prior aggressive days in the upward direction. Next up, last but not least, AMD, and then one final idea, and I'll send you on your way. What do we see out of AMD? Consolidation range, I think that you want to sort of be mindful of the opportunity for AMD to maybe produce something that looks like a Tesla, right? So as you're getting consolidation, remember, the longer the consolidation, the larger the move. The longer the consolidation, the more anticipation. The longer the anticipation, the more positions are being built. And I think you could sort of apply the same logic to AMD. Now, it doesn't mean that AMD needs to do something like this and go parabolic. I want to be very clear about that. But the consolidation phase is definitely there. If we clear 174 and this actually wants to go, I don't see any reason why it wouldn't come into the 183.15 shelf here. If it breaks that, we're talking about 193.60, and that would be quite an explosive move out of AMD. Now again, don't jump the gun. Wait until we clearly either have a bull flag set up here over the top of this level. That's 165.50 FYI. So consolidation there, break through the highs, or let it go, find the higher low above this prior pivot high, this high here, and then look for that follow through into those upper targets. I would not be bearish on AMD until we're actually underneath the bottom end of this consolidation. Reason being is that the bears had one chance, they had two chances, they had three chances. 3 chances have failed. So now it's right back in the court for the buyers. See if they can make it happen. If not, again, side door number 5, right, is always a possibility as well, sideways in the range. But for now, probably leaning more bullish, looking for this consolidation, trying to navigate the higher low over 174 on AMD. One singular trade idea and then you're on your way. Snowflake is the lucky winner today. And I don't know if we should be calling it lucky because it's actually a bearish setup. If the broad market starts to pull back and we need short opportunities, this is why I've included this in this week's episode. This, I think, is where we want to look. Not only is there relative weakness, but look at how great the setup looks, right? You've got this extended counter trend move after a large breakdown against a prior structural area, as well as the daily 50 SMA. On Friday, when the broad market's printing brand new all-time highs, you get a bearish inverted hammer out of Snowflake. So I think that this is a no-brainer, watching for the 144.65 area to act as resistance, and underneath these 2 equal lows, if we could grab the proper tool, we're going to start looking for some short opportunities under 140.65. Let's ensure, we'll actually take this one down to the hourly time frame chart so I can show you with a little bit more nuance here. We're looking for a thin structure retracement, right? So the idea is something that consolidates up here is bearish as long as we're rejecting that 50 SMA and daily level we were just talking about. Under the 2 equal lows, 140.65, thin structure retracement into this level, which was a gap fill reversal at 135.40. Let's go 135.25 actually. We'll round down on this to sort of capture those areas back here a little bit better. So possible short trade if the broad market is pulling back and you don't want to stick your neck out there and try to short something like Microsoft, Apple, NVDA, any of those names that are massively bullish, trading up near all-time highs. Snowflake is an awesome alternative. That's all I've got for you on this sort of first episode back after the 4th of July holiday weekend. Hopefully you had a fantastic one, enjoying burgers and dogs and whatever else you can grill up out there. Continue to have a good time with friends, family. Come back into the markets refreshed for Monday. We'll get this show on the road. We'll be live up in the pre-market prep, hanging out in the penthouse, doing what we usually do. Back at it on Monday at 8 o'clock. Of course, Thursday, CPI, we will have coffee and donuts. So if you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. With that said, I wish you a green trading week. We will see you in the next one.